Hey everyone, it is Monday, and you know that means we start off our expert series strong. We bring on Greg Dickerson. How you doing, sir?
Doing great. Mondays with Michael. How are you doing?
I got to tell you, I love that. I'm doing well, man. I've been looking forward to this conversation since Friday because I have come to believe that we are about to see particularly safe asset become less safe. And investing speak, that means cap rate expansion. So what I wanted to talk with you is, hey, let's talk about cap rates. Let's talk about what it is, how it's used by the average investor, how you use it, and then really talk about the evolution, because I think there is a particularly safe, historically safe asset that is not going to be safe for the next decade. So what do you think about cap rates?
Cap rates. So cap rates are a very misunderstood thing. So the definition of a cap rate, when you look at the dictionary, you look at Investopedia, the financial world definition of a cap rate is the return. It's the rate of return expected by an investment in a real estate property.
Mm-hmm.
So if you're going in and you're paying cash for a piece of property, a stabilized asset, fully stabilized, and you pay cash for it, the net operating income that you receive in exchange for that purchase represents the cap rate that you paid.
Yep.
So if you divide the net operating income by the purchase price, that gives you a cap rate. Okay.
Mm-hmm.
So that's the definition of it. The problem is that it's only good for a stabilized asset. And then of course you have to factor all of your costs, to close that transaction
Mm-hmm.
into the equation. So you got to take the net operating income, the cost of the purchase and all that to get a true net
Yep.
income off of that property for the first year, and then it's ongoing. Now, cap rate is used to value commercial properties because which represents a sentiment. So it's a market sentiment.
Yes.
So the market feels like these assets are worth X multiple of the income that's generated, which is a cap rate. So there's a lot of different ways to look at a cap rate, and cap rate in terms of evaluating a potential opportunity or investment is a pretty meaningless metric to use. So if you're looking at nothing but cap rates to make an investment decision, you could be missing the boat just by relying solely on a cap rate.
Mm-hmm.
Now, appraisers use cap rates. So they, when you value a commercial asset, you look at the income approach, which is a cap rate based valuation. You look at the replacement cost and you look at comps. That's how commercial properties are appraised. So, cap rates are a tricky thing. But what it is more than anything else is a measure of market sentiment in terms of the value of an asset, the type of a property and the class of a property, and sometimes the risk, because a lot of people think that cap rate can indicate risk and level of risk, and that's not always accurate either. So it's a lot of things, and it's something that you just have to kind of take with a grain of salt and understand that it's a stabilized asset return metric.
Yeah, cap rate is one of those terms that gets, in my world, gets thrown again, right? I'm the single family guy in this space, but I talk to plenty of, single family folks that want to go multifamily. Lots of people multifamily throw it around like, hey, they throw it around like it is gospel, right? Like it's the only variable to make a decision. And that's wrong. If that was the case, you would only buy C-class properties in C-class areas because those have the highest cap rates. I mean, that's what it would say. But again, I want to talk about cap rate a little bit more before we dig into what I see coming. Cap rate can vary by area. I mean, let's design a 100-unit building and put it in New York, put it in Denver, put it in Detroit, put it in LA. The same apartment, just pick it up and you will get a different cap rate by area. Is that fair?
Oh yeah, even areas of New York City. So if you're talking about New York City, not the state, but the city, Manhattan's going to be very different than Brooklyn's going to be very different than Queens, going to be very different than
same physical asset. I just want people, the novices, to realize that even in an area, the same physical asset dropped anywhere in the country can have a different cap rate.
Yeah.
Okay. Second, classes within the same street. Like let's pick any street, whether it's New York City, Madison Avenue, or Main Street, Timbuktu. Two buildings right next to each other, one brand new, one 50 years old, one's a class A, one's a class B minus C, whatever, different cap rates, correct?
Yeah, it can be. And, again, classes are generally defined by age and condition of the asset itself,
Yep.
in the market area that it's in, but you can have a 200-year-old building that's been totally refurbished. So that
For
could be
sure.
a Class A right next to a brand new one. But yes, you can have them side by side. One can be a Class A, one can be a Class C.
I just want people to realize that when people throw cap rates around and then they say, hey, get a 5 cap or get a 9 cap in New York, that doesn't tell you the full story, is I guess what I'm trying to.
Exactly. Yeah. You could have a Class D property in Manhattan right next to a Class A brand new office building. Absolutely.
That's what I'm saying. Yeah. Awesome. So historically speaking, the lower, this is my opinion. If you agree, great. If you don't, tell me where I'm wrong. But historically speaking, the lower the cap rate, the less risky an asset is perceived by the investors.
Yeah, that's correct.
Okay. So a 4 cap is seen as less risky than an 8 cap.
Right. For the yeah, all things being equal
Yeah,
on a
all things
Class A
being equal.
type asset.
Yeah,
Yeah.
I mean, asset to asset. I'm just want people
Yeah.
to understand, when people throw out this term, what it could mean. So when you are buying a 4 cap, right, or someone is buying a 4 cap, again, it's a stabilized asset. They are also making assumptions about the future. Is that fair?
Yeah. Yeah. It's like a bond. It's a yield play.
Exactly. So they probably are calculating rent growth. They are probably calculating capital improvements, value add, right? There are operating costs, right? Because again, NOI, right? You're taking gross rents
Hmm.
minus expenses. So there's that expense number. Those are all considered in that, rent growth being one that's, probably most important. Is that
Hmm.
fair?
Yeah. Well, so when you get into the lower cap rate deals that are
Mhm.
stabilized assets, Class A, there's not a lot of upside. These are core assets.
Okay.
And I want to clarify another thing. So cap
Sure.
rates are confusing. So is type and class. So
Yes.
for people that are listening to understand, a lot of people use multifamily. They call that a class. They
Yeah.
call self-storage a class. They call industrial a class. Okay. Real estate is an asset class. And
Mhm.
within real estate, there are types of properties. There
Correct.
are commercial, there's multifamily, there's industrial. And within those types, there are subtypes,
Mhm.
of different types of properties, hospitality, land.
Mhm.
So, there's really only 7 types of real estate, the commercial, multifamily, industrial, land, hospitality, and retail and office.
There you go.
Those are your types. And within those types, you have subtypes and you have classes, A, B, C, D. So real estate is a class.
Mhm.
Multifamily is not a class of real estate. Within multifamily, there's class A, B, C, D,
Mhm.
So I wanted to clarify that because a lot of people get
Thank you.
confused. Well, what did I hear class on this and that? And what's this class stuff?
Yeah.
You know, um, just understanding that. And then, in terms of the low risk and what a core asset is. So if you're buying a 3-4 cap, that's a core asset generally for the institutional buyer that's looking for a yield play, a bond play. They're looking long term. They're not always projecting rent growth. What they're projecting is a consistent flow, almost like an
Okay.
annuity. So
Got it.
they're not saying, hey, we can raise rents on a core asset. They're just saying, hey, this is a core asset. We don't
Right.
need to raise rents. We know what our predictable yield is going to be over a 20-year period.
But they're not forecasting rent drops.
Yeah, I mean they're going to stress test it before they buy it and understand
Right.
where that is, but no, they're basically saying it should hold here,
Right.
it should go up,
Yeah.
but we're happy with it right here.
Yeah. We're happy here. Right. And any
Hmm.
upside is great, but the downside, again, it's a core asset. So the downside is relatively protected when they make the
Exactly.
acquisition.
And they're
Okay.
going to look at it both ways. They're going to have a pro forma that says we should be able to increase rents, we should be able to increase operational efficiencies,
Yeah.
this, that, and the other to increase the income. Ultimately,
Yeah.
the value is based on the income that you
On the net income. Yep.
generate.
Yep.
But they're also going to stress test the downside,
Okay, good.
and say,
Yeah.
hey, where are we in trouble?
Yeah.
And we'll get into that in a minute and what that means.
Yeah.
Based on your video you did the other day about these things losing value and things.
Yeah. So my again, I'm going to give you my opinion. Please tell me where I'm wrong. When I think core asset, I think Class A, name brand hotel or name brand apartment building, peak rents, all the amenities, that's when I think of core asset, right? Hedge fund or an insurance company or whoever's the buyer of these things, it is the primo property, hence the lowest cap rate. Is that fair? Is
Yeah.
that where core plays?
Yeah, in a prime market
In a
location.
prime
So
thank you.
yeah, so primary market locations, you have primary, secondary, tertiary.
Ah,
Primary markets are like, San Francisco, Washington, D.C., Los Angeles. Those
mhm,
are your big primary core markets with
gotcha.
core assets.
Yeah,
Core can also mean urban core, but it's
sure.
generally core meaning big primary market. Then you have your secondary suburban markets. You
Yep,
can have Class A assets in there as
sure,
well.
sure.
And then you have your tertiary markets, which generally you're not going to see Class A. I mean, they're going to be new assets, but they're not going to typically be your traditional core, what you would call a core Class A asset, which is in a primary market in a major metro.
Perfect. Awesome. So now we've got to really where my brain has gone this weekend, and it really, I don't know, scared me, also brought up opportunities. But I was thinking
Mhm.
about this core markets, and I'll just use San Francisco and New York as examples because I think everybody realizes what kind of pain is going on in those markets. I'm starting to ask myself, what happens if those historically core, least risky markets are suddenly the most risky, right? We are seeing in New York and San Francisco 20% rent drops already. We are seeing record vacancies in both cities. We are seeing 3, 4, 5 months of free rent being offered to re-sign leases. All of that leads me to believe that, first off, top line revenue is going to take significant hits. Second, operating expenses are going to go up because I know managing buildings with turns is more expensive. And then the real kicker is, if these once core assets, lowest cap rates, aren't seen as the riskless asset that they once were, what happens to values? I did a video, I think it was Saturday morning, where I turned $100 million Class A property into a $50 million asset, wiped out the equity entirely, and required a $30 million capital call if the owner wanted to keep it. It's pretty scary stuff. So am I crazy? I mean, would somebody who owns a core asset like that, I mean, rents are falling in San Francisco and New York, right? I mean, where am I
In
wrong?
certain areas, yeah, in certain areas. And, so again, it's all, location based.
Mm-hmm.
And when you look at cities now, San Francisco is different. What's driving that is Silicon Valley. Okay. It's those jobs, which are now spreading throughout the country.
Yeah.
So we are in a world moving forward where you're no longer going to be required to have to live in San Francisco to work for a tech
Yeah.
company in
Their
Silicon Valley.
employers are telling them to leave. They're telling
Right.
them, like, go.
So Manhattan's a little bit different. New York's a little bit
Okay.
different. San Francisco has unique challenges that New York doesn't have.
Okay.
Okay. Um, the homeless thing is a big problem in San Francisco. You
Oh,
don't see
yeah.
that going on in New York. You
Okay.
don't see people pitching tents on sidewalks at scale,
Yeah.
in New
Every
York.
overpass in San Francisco has a tent city.
Yeah, that's not happening there.
Okay.
They've got pretty good control over that. And the other thing is it's New York, right? And you're talking about 8 million people. So what
Mm,
we've seen a couple 100,000 maybe leave the city, So I mean that's not going to put a dent in New York.
mm.
What you got to watch in New York is more inventory than Exodus.
Okay.
So Hudson Yards, for everybody who's watching, go Google Hudson Yards and look at that,
Yeah. It's
millions. It's the
massive.
largest real estate development in the country ever, vacant. It's a city within New York that's just been built and brought
Mm,
onto line, vacant office buildings, residential units,
mm-hmm.
all that kind of stuff. So what you're going to see is you're going to see a lot of these things, the new product being brought online that's going to sit.
Mm.
Hotels are going to be closing left and right. I mean, the hotel industry's got some major pain coming into next year. If they don't try to clear the books with those assets this year, it's going to be next year.
Yeah.
A lot of pain in the hotel industry, a lot of pain in the office industry. Residential, I'm not so concerned with
No.
because it's not enough people yet to
Yeah.
make a dent at scale
Not concerned.
the entire market. Now, I don't know about San Francisco. There's a bigger problem there, I think,
Yes. Yeah.
than there is in New York. But you are seeing a lot of millennials leave New York
Mm-hmm.
because they're paying exponentially more to live there for the amenities that they can no longer enjoy,
Mm-hmm.
and they no longer feel safe enjoying because
Yeah.
again, they generally do a pretty good job with crime in New York, but with the civil unrest that we've seen the last several months, people are starting to feel unsafe. They can't even go out to eat without being accosted,
Yeah.
by protesters,
Yeah.
things like that.
Not good.
So there's a lot of those types of things happening, and it hasn't been so much lately, but that's really concerning people. But I mean, New York's New York, man. There's people that they ain't leaving, they ain't going nowhere. It's the greatest city in the world.
Hmm.
You know what I mean, in terms of economic activity.
Yeah.
So what'll happen is, as these assets decrease in price, they'll get to a point to where somebody will snap it up because it's an annuity.
Yeah.
You know, it's the
But
building's
but
not
but
going
hold on.
anywhere.
Yeah. So absolutely, there's always a clearing price in good
Hmm.
assets. But I guess what I'm thinking is I believe every crisis teaches us something.
Hmm.
And what I also believe is every crisis um, challenges a once long held belief. For example, the housing crisis, the Great Recession, you and I know near and dear, challenged the mindset that houses only go up, right? I mean, everybody said it, right? Even though we knew logically it wasn't true, but everybody was saying it. I mean,
Yeah,
every
and the
cocktail.
biggest, best investment you're supposed to make is a
Yeah.
house. I got married in 1990. I was 23 years old, and that's the first thing we did was buy a house. That's
Yeah.
what I was told.
Yeah,
Buy a
exactly.
house as soon as you can, and buy as much house as you can.
Exactly.
Max it
Stretch.
out.
Max it out.
Yeah.
Yeah. Yeah. So that was the mindset in the Great Recession. I believe a lot of new YouTube entertainers and all of this are looking at today's market and pointing at the last recession and saying, see, it's going to happen again. I've done endless videos the last 10 days and basically saying you idiots are wrong, right? I've even done math to show how stupid they're being, right? Again, just real quick. I did a video yesterday showing how a 6.5% mortgage on 250 grand equates to a 400 grand mortgage at 250. You guys are freaking idiots. It's not going to happen. But where I'm going with this is the long held belief today that I think is going to be challenged is what we've been calling core or low cap rate assets are riskless
Right.
or perceived riskless. I see cap rate expansion. And if you take cap rates from 4 to 5, 5 to 6, just at 1 point, it makes a huge difference in value. And where I'm going with this is commercial paper, unlike residential, will reset, right? Or will come due, right? 3, 5, 7, 10 years. And if the bank comes back and reappraises and the cap rate's gone from 5 to 7 and income's down and expenses are up, your equity's gone.
Well,
So
not only that, what a lot of people don't realize, when you execute a CMBS loan, which generally those assets are financed under, or a agency loan, Fannie and
mhm,
Freddie,
mhm.
in the loan covenants, they're going to have requirements of equity, requirements of value, requirements of income levels, and occupancy.
Yeah.
So you can be placed in default if your occupancy drops below a certain percentage, if your debt service coverage ratio gets below a certain percentage, that they want for the loan. If the value gets below a certain percentage, they can declare you in technical default and foreclose on the property.
Now, this is exactly where I wanted to go because I see that happening. I mean, if there was a Class A asset traded in 2018 or 19, and you have like 3 or 4 year, 5 year terms, I'm very concerned for you because you paid near peak pricing. You had assumptions that probably had rent growth or at least no rent decrease. Now you could be operating, and especially if you're urban, like condos or something, like tall towers where you got to wait half hour for an elevator. Oh my God, those assets are going to have more vacancies than planned for. Rent drops, and I guess the question is, when do they test it every year? I mean, when does the bank come in and go, hey, let me go look at your asset? Is it once a year? Can it be any time?
It depends on your loan. Sometimes you have to submit,
Yeah,
your
yearly
financial
pro forma.
documents on an
Yeah,
annual basis.
yeah, I have to do that.
And generally that's standard. And in the current environment, they could be asking for certain operators. They might be asking for it more often. It depends on how
Mhm.
current you are.
Yeah,
If you're current, things are going well. Minimum annually, you got to resubmit your financials.
that's true.
But if you're in a situation, they're going to ask for it, on a regular basis.
Yeah, and then this leads me to my next point is I don't see the same residential pain, meaning banks taking back single family homes. It's just not there. But
Yeah, it's interesting. So the forbearance program. So a lot of
yeah,
people are putting stock in the forbearance program, and we just saw a report out today that it's up
yep,
for
I
the
saw that.
month. That
Yep.
more people entered the forbearance program than they thought. So you got to understand again what forbearance is. It's a break. Most people, you don't have to do anything but call up and say, "Hey, I don't
Yeah,
want to make my payments." No
done.
questions asked. They're like, "Okay, minimum 3 months," and then you can
Extend.
extend from there.
Mhm.
So there's a certain number of people that are already in extensions, but people are going to take advantage of that as long as they can. They're just building up their cash flow. They're just
Yeah.
storing up money. We have the holidays coming.
Yeah.
If you've lost your job, even if you haven't, some of them are investment properties, second homes, whatever.
Yeah.
So, people are utilizing that as a tool to build up cash flow. And if they're going to let you miss a payment with no penalty, why not? Now, the thing is, what happens at the end of that forbearance period?
Yeah.
So that's when you start talking about, modifying your loan and going into loan modification. Now that's when they're going to look a little deeper and they're going to ask you to provide evidence that you are in distress, you lost your job, you couldn't make your payments, whatever.
Mhm.
But generally, nobody wants 2009 to happen again. The banks understand the damage that could cause.
Mhm.
And it's only 3 million properties and most of them have equity. So let's assume this all plays out in the next year or so. I mean, you could sell 3 million homes in a year right now
Oh,
with the
yeah.
demand that's out there.
Yeah. I
you
did
know
some, I
so
did
it's
some
not enough
math.
to really impact the housing market.
Yeah. It's not going to
Now
impact it. Not at all.
yeah, now if interest rates went through the roof and builders all of a sudden tripled and quadrupled the workforce and we could outbuild the demand, which we can't do for a number of years. There's a number of things that could potentially come together, but it would take some time for the housing market to
Yeah.
significantly change.
Yeah. It's not going to happen in 2021. Not,
No,
no.
it'll take a little bit longer than that. Now, if interest rates shot up, people would stop buying. The only reason you're seeing what you're seeing is because interest rates are at record lows, and it makes more sense for a lot of people now to own than it does to rent. It's cheaper to own or about break even, to own a house than it is to rent because rents have gone up so much. So that's where the real, I
Mhm.
think a lot of people are missing the boat there.
Absolutely.
Everybody's been pushing rent, and I've said on your show over and over and over, you're going to reach a ceiling on rents. You can only charge so much. People can only afford to pay so much for rents.
Agreed.
And as soon as housing comes down to where the affordability ratio
Yeah.
matches renting, people are going to go buy a house.
Absolutely.
And
that's
they can
again,
build equity.
that's what's going to happen. Again, this is all, I guess the thing that I'm challenged with, and I'm going to ask all my experts this week, is I believe the once safest asset of Class A is no longer the safest. I believe cap rates were historically the lowest. They assumed that the tenant, the customer, the millennial, the high income earner wanted to be there for the city life, all these other amenities, lifestyle choices. And I believe this health crisis, especially in San Francisco, to your point, right? They're like, get out of here, leave, right? Disperse. So we're going to see vacancies. The people that are most financially able to move will move, which is Class A, right? The Class C tenant doesn't have that luxury. They can't pay movers. They can't, it just doesn't work that way. We're going to see vacancies up. We're going to see rents down. We're going to see risk profiles change. And we are going to see Class A assets lost to the bank like we've never seen before. I think that's this health crisis lesson. When we look back in 5 years, it's going to be, oh my God, Class A traded at rates we've never seen before. I think that's what's going to happen.
Yeah, I'm not so sure I agree with that
Cool.
across the board. I think you'll see pockets
Yeah,
where that's the case. But when you go to a place like Manhattan, your Class A apartment tenant is not some young millennial that just whatever. That's a high income earner. That's a couple $100,000 a year.
Sure.
That salary hasn't gone away. That neighborhood is not as in much of a problem as some of these other neighborhoods where your Class B and C apartments are. So we know right now the people that are losing their job largely are the people that are renting in the class Class B, Class C, Class D apartments. It's your hospitality workers. It's your service workers. It's your retail workers. Things like that. The white collar Class A apartment tenants are not the ones losing their jobs.
Not yet.
Now, so it's really going to be dependent on the market. Like I said, San Francisco's got a bigger problem than a lot of areas, other areas of the country for a lot of different reasons. Not just, the civil unrest, the homeless population, and the liberal policies that, are letting, things happen, but also because of the Silicon Valley change.
Exactly.
And what that landscape's going to look like.
Very different.
So that, I think, has a bigger impact on a market like San Francisco than DC. DC's a Class A building in DC ain't going anywhere.
Yeah.
Nobody's leaving DC in that Class A environment. And when you do, you got a waiting list for 4 or 5 other people.
Okay.
The best neighborhoods in New York have a waiting list. Now, that being said, there's Class A Hudson Yards vacant because it's oversupplied.
Yeah.
And it's in the wrong area. You know what I mean? In terms of where a mass of people are going to want to live.
Yeah, I want to clarify. I guess my biggest concern is again, I don't think Class A. I think Class A again. I think the country is tilting, right? Right. Where there's movement out of these big urban vertical cities for the most part south, right?
Yeah.
And I think again, like Class A in Chicago, it's going to be repriced. I think Class A in San Francisco certainly repriced. I do think New York is going to see some price deterioration.
Well, so again, okay, so it's not necessarily the cap rate that needs to change for that to happen. So if
Okay.
the income drops, it can still be a 4 cap. You're just
That's
paying
true.
less because there's less income.
That's
So
fair.
that isn't necessarily going to happen, because Manhattan's Manhattan.
Okay.
That demand for the right assets in that market's not going to change. The question
Yeah.
is, how much can somebody pay? So when you did your calculation, what you need to look at is
Yep.
what happens to a 400 unit building that loses $100 a month rent or $500 a month rent across all of those units at the same cap rate. That
Yeah.
alone will drop the value 20%. You know what I'm saying?
Yeah. So I'm going to do that right now. So 400 units times, I don't know, 3,000
$500.
Okay. 500. Okay. 400 units
Yeah.
times $500 a month times 12 equals 2.4 million. What do you want to make expenses?
Divide that by 4%. Make it a 4 cap.
Okay. So that's the NOI is what you're saying.
Yeah.
Okay.
That's what you've lost.
Okay. I gotcha. Oh, I see what you're saying. I got it.
Yeah.
Okay.
You've lost $2 million worth of NOI just with a $500 a month.
60 million
drop.
bucks.
Right. So that asset just lost $60 million in value. The cap
Ouch.
rate didn't have to change.
That's
cap rate
a good
didn't have
point.
to change. You see what I'm saying?
So I did not do that. So I should go back and look at that math again. Just assume income came down something, 10%, 5%.
Well, that's a $4,000 a month apartment in New York that's now $3,500. That's happening. That's happening.
Oh,
so that building just lost $60 million in value if all 400 units dropped $500.
And the cap rate stayed the same. Wow.
Yeah.
And
You see
then,
what I'm saying?
oh, for sure. All right.
So the cap rates may not necessarily change. A 3 or 4 cap asset will still be a 3 or 4 cap asset, but they're just going to pay now. What's the actual income?
Wow.
Yeah.
Scary. Okay.
Now it goes the other way too. So if you buy that asset now at, $60 million less than what, somebody sold it and you get the rents back up, well, now you've increased $60 million.
Yeah.
You didn't do anything but raise rent. So that's why the value add game is so popular, because it's been that easy to do.
Yeah.
You buy an apartment that's renting 200 units for $1,000 a month. You raise that rent. Do this real quick.
Okay.
Take $100 a month times 200.
All right. 1 6. So 100 times 200, that's 20 grand.
Divide that by 5.5%, 5.5 cap.
Divided by 0.055. So that's 363 grand.
Okay.
I didn't times it by 12.
Rents.
Yeah.
You do nothing else. You get 200 unit building. You buy it today. At the end of the year, you've raised all the rents, $100. That's all you've done. Nothing else. You've all of a sudden increased the value of that asset by 360 grand if the market is a 5.5 cap for that asset.
Actually, let me. I didn't do it right. So I only did once a month. I should do
yeah, that wasn't annual. Yeah, it was kind of low. Yeah.
Yeah, sorry. So $100 times 12.
Could be $1 million.
Yeah, times 200. You said right? Equals
200 units, $100 a month.
Yeah, that makes more. Yeah, 4.4 million. Yeah, 4.4. So that's the whole game, right? But again, I guess the big fear. So yeah, you're right. Just with NOI going down, which just means top line revenue down, you could see significant evaluations, even if the cap rate stays the same, and you could see the need for capital calls or foreclosures. I mean, a $60 million fall, that's enough to wipe out at least a lot of the equity that was there. Is that fair?
Oh, yeah. Yeah. I mean, because generally you're going to finance those properties, 60% of the value. So you got to put 40 to 50%, equity down on those buildings. That's usually what's going on at the higher level.
Yeah.
People aren't financing 80%. They're financing 60, 65.
Yeah.
So before you get to default, you can lose 30, 40% of your equity before you start facing that. But again, once that thing drops that much, you could trigger technical default depending on what your loan documents say.
Yeah, let's just do easy math again. Let's say it's $100 million building. You close with a $60 million loan. It doesn't take a lot of drop in NOI for you to be in technical default, right? If you lost $20 million, you're in default, right? Because now the building's worth 80 million and you have a $60 million first. You've got to do a capital raise.
Yeah.
Oh, so that's my big fear. That's what I think is going to happen in this health crisis. It's not going to be single family. Banks are working. Banks don't want to repeat. Lots more equity, lower mortgage rates, all the things we've talked about. I believe it's going to be multifamily. And again, regional multifamily. Let's be very clear. I don't think this is across the country. I think there are plenty of metros south that are doing great, having rent growth. Atlanta has rent growth.
Mm-hmm.
So this is very urban, big city concerns, I guess I have, going
Yeah.
on for the next year or two.
Yeah, it's interesting. And, right now, again, it's not enough to make a dent pretty much anywhere. You're talking about 100,000 people here, 200,000 people there in cities. What's the population of San Francisco?
I think it's 8 or 9 million, I think.
Yeah. So,
Yeah.
I mean, it's not enough to make a dent there, but it's enough, like 200,000 or 300,000 people going to Atlanta, going to Charlotte, going to
when they didn't
Nashville.
expect them. That's the key. They didn't
Right.
expect them. They didn't build for it. There's no ready supply. It just raises prices.
Yeah, I read an article the other day about some little town in Vermont. It's like a summer vacation destination spot that a lot of people from the, New York, New Jersey go to in the summer.
Yeah.
That the population of the town was, I don't know, a few thousand. Now all of a sudden 10,000 people have moved there.
Yeah.
It's
crazy.
like, yeah.
Same thing in Lake Tahoe, here just across the Nevada state line for obvious reasons, no state income tax. They've seen just crazy things. Real estates have gone up 25% in 90 days.
Yeah.
Crazy.
Now,
schools
that's
are
the
up.
other thing. So, commercial real estate, it's all about NOI. So two things are going to affect these areas. So taxes are going to be going up while rents are going down.
Yeah.
Insurance costs are going up because of all the fires, floods, all that kind of stuff.
Exactly.
It's going up across the board. All of the civil unrest that's happening in these cities, that's increasing insurance rates, things like that. So, all those things chip away at NOI. And that exercise we just did, we did do that calculation wrong on 200 units. If you raise the rents $100 a month on 200 units, that's $4 million.
Exactly.
And that you've improved the value of that property in 1 year. If you could raise everybody's rent just $100.
Exactly.
That's why the value add real estate game is so attractive and so lucrative. The problem is, again, you got to be careful because, people will start pushing back at a point where, the affordability index gets crossed because people can only spend, in most areas, take the cities out of the equation, you can spend more in a city because you don't have to have transportation, this, that, and the other. But when you're in suburban areas, what is it, 30, 35%
30,
is the most
33,
you want to spend on
35,
housing?
Yeah. Before
And,
you're
we're
housing
getting
constrained.
above that. Mm-hmm.
Yeah, it's pretty concerning. Well, very cool, man. This has been fun. I think cap rates is a conversation we should have had before. I'm glad we had it now. I do think NOI cap rates are going to be affecting urban cities down, right? At least the NOI is going to be coming down. And I think there'll be some good deals in multifamily for the people that have the cash ready, in 2 or 3 years. So it's going to be fun to watch.
The biggest shoe to drop is going to be, hospitality, office, and retail. That'll be really interesting to see how that shakes out.
50% discounts.
There's going to be a lot more issues there than multifamily across the board.
Mm-hmm.
And for everybody who's interested in cap rates, there's a Spencer Levy, who is the chief economist for CB Richard Ellis, CBRE, largest commercial brokerage in the world. He did a YouTube thing on cap rate. If you want to get really confused, go watch him explain a cap rate.
No, thanks.
Yeah.
Very cool, man. Well, thank you for your time. This has been fun. Any closing thoughts?
No, that's it. It's all good. It's all opportunity. And it's just different ways to understand where the opportunity is created in these commercial, assets, these larger assets.
Very cool. Well, Greg, I appreciate your time. You have a wonderful week. All right.
Yep. You too.
All right.